Joining us on how he is positioning heading into the end of the year, Wilmington Trust CIO Tony Roth is with us. Tony, happy Thanksgiving. It's great to see you.
You too. Happy Thanksgiving. Thanks for having me.
Per the conversation we were just having with Mike, you do sense that inflation is coming down, maybe even faster than some of the Fed projections?
I think that's right. I think that when we look at the components of inflation, what we see is at the headline level, energy's rolled over now at this point, and within the core of inflation, we see pretty much all the areas other than labor costs also rolling over. And we have to put inflation in context when we think about labor costs of where we've come from. In the pre-pandemic period, labor generally grew at around 3 to 3.5% a year. Right now, we're around 4.5% a year. So we only need to get about another 100 basis points off of average hourly earnings or the employee cost index, whatever your preferred measure is, in order to be in a place that's consistent with the Fed's target. And the other thing that we should mention is that when we look at what the Fed rhetoric is doing, they're being very successful in controlling inflation expectations, which is to say that it's a little over 2% at a 10-year part of the curve. And that is all based in their rhetoric around not expecting to see inflation reach target until 2026, still being very hawkish in their minutes, et cetera. But we can ignore all that, really, as long as they're controlling inflation expectations. Once it's time to cut, they'll cut. And they're not going to indicate that they're ready to cut until very shortly in advance.
Right. All that said, you do believe, given the quarter we just had on earnings, that we're well past peak margin, the guidance going forward not all that hot, and that's resulting in what? Is it an underweight in equity?
Well, when we look at the equity markets, it's almost looking at 4 different markets in today's world. So overall, we do have an underweight on equity, but we have a market weight on large cap, and we have a market weight on emerging markets. Where we're underweight is in small cap and EAFE. And so you think about small cap, for example, what's happened this year is we're essentially flat on the year on small cap versus 18% up or so on large cap. And so they're almost different markets. The intra-equity correlation in these 4 different areas has been very low, and that's benefited investors from a diversification standpoint. So yeah, we're underweight equities, but we're specifically underweight small caps. I think that what we're considering is adding to equities, but probably adding to those areas where we've been essentially a market weight, which is large cap, and that's the largest component of the equity pie, of course. Adding to that sometime soon, but not adding to small cap. Because when you think about what's going on with small cap, all of the underlying reasons that have weighed on small cap that relate to, for example, being economically sensitive, not being able to access credit, the fact that all the banks that are hurting in the community space, the smaller banks, they're all in small cap, 40% of small cap stocks are not making money. All of those factors are going to continue to essentially inflict pain in that area of the equity spectrum until we get to an environment where we can sort of see through to the other side after the soft landing what comes next. Do we go into a hard recession, or do we sort of power out of a soft landing into another period of growth?
And what would you watch on that front? How do we know whether soft landing turns harder? Because we're already starting to watch these rising delinquencies and bankruptcies and other problems normalize. But you do wonder when it becomes more worrisome.
Yes, Sarah, there's 2 things that I think that I would focus on. One is I would focus on, is there a catalyst to really create the kind of recession that is typically associated with significant contraction in GDP, which means significant job growth, significant job losses, excuse me. Typically, when you see that kind of recession, there's a catalyst. There's excess somewhere in the economy. It could be in the financial economy. It could be in the real economy, whether it's the housing market, whether it's bank lending, whether it's a bubble someplace in the economy. We're not really seeing a catalyst for the kind of recession that would really weigh on the overall economy. Could we see a recession in growth the way we did last year in the first 2 quarters? That's certainly possible, but not with the job losses that we expect, because we just don't see that catalyst right now. The other thing that I would keep a very close eye on is productivity, because as companies move forward and essentially cope with a much tighter earnings environment, a much tighter profit margin environment, if they can grow their productivity the way they did with the last productivity report, and the way that we think they're going to be able to do as they increasingly incorporate AI and other forms of software, they'll be able to continue to keep the economy moving, continue to spend on CapEx without having a recession. So those are the two things that we would be watching.